Hello, Charlie Redding from Efficient Portfolio here. Welcome to the next video in our client case studies series. This is the series where we send to our strategic partners examples of how we've helped different people so they can get a better feel for what we do and how we may be able to help your clients and add more value to your proposition. So in this case study, I'm going to go through somebody that was selling their business. They sold the business and they were receiving net of tax £5.5 million, and their biggest concerns were minimising tax and making sure they'd got enough income for the rest of their life. Now, £5.5 million sounds like a lot of money, but it depends how much you spend. And that's ultimately what we were looking at for this client. And what we were looking at was their whole situation, taking account of everything they'd got. And we said, well, actually, if you want to spend £100,000 on all the other stuff, there were some fixed costs in there as well. If you want to spend £100,000 on the nice to haves in life, all of the things that he wanted, that actually that £5 million or £5.5 million wasn't going to be enough. And you can see from the lifetime cash flow forecast here, he was going to start running out of money at about age 93. Now, age 93 is not a disaster, but actually, you want to make sure that if you're living to age 100, you're going to have all the money that you need and still have some to leave over, hopefully. And certainly from £5.5 million. And we can see from the liquid assets chart that what was happening is the assets were being eroded over the course of his lifetime. And so what we then said was, okay, fine, what would 75,000 look like? And we could see that actually 75,000 was going to be okay, and that was a sustainable amount of money to spend on all of the sort of non-fixed costs, as it were. So 75,000 allowed us to be a little bit more sensible and kind of rein his expectations in. However, what we could then do is start to say, well, okay, yes, 75,000 gets us enough, but what about a flexible income? What about making sure that we've got all of the funky stuff done in the early part of retirement? You know, we all want to do the bucket list in the first sort of 10 to 20 years of retirement, but accepting that if you spend a bit less as you get older, then that will still leave us with enough money. And actually creating a flexible income allowed us to have a much better life for that first 20 years of retirement, doing all of the things that he wanted to do, whilst also making sure that if he did live to age 100, he would have enough. So the cash flow forecast is such a powerful tool in this situation because it allows us to say, well, okay, yes, if we do this, you can afford to spend this much money now, but you can't afford to keep spending it. So it gives us that roadmap to run on. It also allows us to revisit this each year and say, well, okay, given what the markets have done and given how much you've actually spent, this is what it now looks like. And it's our early warning system to say, look, actually, you're spending too much money. Even though we thought you were going to be okay, actually you're now on track to run out because you've actually spent more than we said. So it's that early warning system and it allows us to plan far better. So then we came to minimising tax. Now this guy was obviously getting a lump of money and we wanted to look at how we could make sure that we could generate a tax efficient and ideally tax-free income. Now that's a great income to be getting £100,000 a year but not actually paying any tax. And actually with this guy we can pretty much get there. So we obviously need to use up his ISA allowances and continue to use those each year going forward. We need to maximise his pension allowances, but we don't want him to spend that pension for as long as possible. We want him to keep that and preserve that because that's really valuable from an inheritance tax point of view. We used a personal investment portfolio, which is similar to an ISA, it's just outside of the tax wrapper. But it's the tool that we use to use up the capital gains tax allowance each year. So we've got the ISA that's growing tax-free, we've got the pension that's going tax-free, but it creates tax when we draw money out over and above the first 25%. We've then got the personal investment portfolio, which each year will use up the capital gains tax allowance and allow us to fund the ISA each year so that we know more and more of that's growing tax-free over time. Then what we were able to do is set up an offshore bond for this particular client. And what that means is he can essentially defer the income tax on all of that money that he puts into the bond until the day he dies. So he can draw a tax-deferred income until the day he dies from that bond, which is really powerful in this situation. So he'll pay no tax for many, many, many years, and that means that he can get so much more out of the money that he's worked hard to create. This particular client, he was having a big income tax hit at the end of his career because he'd sold this business. So we were able to use venture capital trusts partly as a kind of almost like as a pension alternative, and add on to the pension over and above the pension allowances. And so that allows us to claw back some of the income tax he's paid. And in fact, actually in 5 years' time, we can potentially take that money out of the venture capital trust and recycle it back in and get another 30% income tax back. So the venture capital trust for the right people are really powerful tools. And then what we were also able to do for this client, because of course his business was previously qualifying for business property relief, so he actually didn't really have a huge inheritance tax problem until he sold his business. Now this guy's too young to be putting money into trusts and things like that at this stage, and we've seen he's probably going to need most of this money. So we don't want to be putting money into trusts yet, although we may do in the future. So in the short term, what we'll do is we'll put some insurance in place to make sure that if something unexpected happens in the next 10 or 20 years, he dies sooner than we would expect, then we've got a lump of money sat in trust waiting to pay the inheritance tax. What we'll do then is over the course of the next 20 years, we'll start to reduce that liability through trusts and things like that as and when the time is right. But in our experience, just as he sold the business, just as he's got all this money in, it's very difficult to get your head around then giving it up and putting it into trusts or giving it to the children and things like that. So this buys us time to get our house in order. So that's an example of how we've helped somebody selling a business. We actually help quite a lot of people at the point of which they sell their business. I would always encourage them to get it, for you to introduce your clients to us before they've sold their business, as early in this process as possible. The more planning we can do prior to the business sale, the easier it is for them. Also, the power of lifetime cash flow forecasting helps them understand whether the offer that they're being made for their business is enough. Is that enough for them to live off? And if it is, then they may end up accepting an offer that's lower than they originally would have done because they know that they can live the life that they want to. I hope that's useful. If there's anything we can do to help with a client of yours in a similar situation or in a completely different situation, please get in contact with us. We'd love to help you. I hope you have a great day.